I'm Matt Schechtner. It's my great treat to serve as Executive Director of Advertising Week. We've been doing this since Roosevelt was president. That was a test? No, since 7 years. It's our 7th year. And the sort of overall grounding principle of the Thought Leadership Program is to put folks on stage who are leading the way forward. So whether it's in the white-hot areas of the business like social media or mobile or gaming or anything digital, or just overall leadership in plotting the course for the future, that's the core strand of DNA that we seek to find. And we've seen many familiar faces here. The Thought Leadership Program is reinvented completely every year. And we are over the moon to have not 1, not 2, but 3 bites this year of the apple with MDC Partners, which when you think about who is leading the way forward in our industry on the whole, they are certainly right at the very, very top, if not the top of the list. So we are thrilled to have MDC. This is the first of 3 MDC seminars. We're just over the moon to have Miles and such a great group here. So without further ado, let's welcome our dear friends at MDC Partners. Thanks, everyone.
Good afternoon, ladies and gentlemen. It's a pleasure to be here, and thank you for the opportunity to present what we think is an interesting topic that I have felt for a long period of time was noteworthy and worthy of dialogue. My fundamental belief has been that marketing has changed very radically, and that the level of accountability of corporations toward driving return on marketing investment was going to change, because ultimately the pressure on companies to produce tangible, measurable financial performance and drive return on marketing investment would be greater and greater, especially in a low growth economy. I was privileged to assemble 3 distinguished colleagues who come from a little bit different areas, but all have great understanding, expertise, and insights. To my far left is David Kirchhoff. David is the President and Chief Executive Officer of Weight Watchers. David has had a distinguished career, first at Boston Consulting, but second of all in different areas of responsibility in growing areas of importance in management in the Weight Watchers organization, and most recently he is the President and CEO overseeing a network of over 19,000 service providers in just about almost every community around the world. David has done some transformational things about utilization of marketing and the building of Weight Watchers. To his right, or my left, is Lee Cooperman. Lee is a person who I've gotten to know exceedingly well. He comes from the most humble of beginnings in the Bronx. He went to Columbia University, where he got an MBA, and he spent 25 years at Goldman Sachs, and for 15 years he ran research. Subsequently, he started in 1989 a firm called Omega Advisors, and Omega is one of the most successful money managers in the world. Today, the firm runs about $5 billion. He's had a compounded annual return of 16% pre-fees, or you made 900% on your money, of which 20% is his money. He is an extraordinary person in many ways, and last week at a dinner with Warren Buffett and Bill Gates and Melinda Gates and Michael Bloomberg, decided to join an illustrious group where he would pledge over 50% of his net worth to charity, and over $1 billion over the course of his lifetime. Russ Klein is someone who's obviously quite well known to all of us. Russ is probably one of the most prolific chief marketing officers in the history of advertising. He won numerous awards and great acclaim for his leadership as the CMO of Burger King during the transformational period when it was sold by Diageo to Goldman Sachs, Texas Pacific, and Bain Capital, and then subsequently went public. What's extraordinary is the innovation that they put forth. Some of this is not objective because of my association with Crispin Porter, bless you. But as Bill Parcells once said, "You are what your record says you are." During that period of time, over $2 billion of shareholder value was created. Shareholders, after the sale, will have made 12 times their money, and the growth in same-store sales and the market penetration and all financial comps are without compare. So I thought I'd put together a panel that I thought could give different perspectives on the basic premise about accountability, of shareholder value, about driving return on marketing investment. And I thought I'd start off by asking Lee Cooperman just to give a backdrop of what's happening in the economy, what he sees at this point in time, and the kind of investments sort of he's looking at in the world in the backdrop of what has been, some of the most difficult economic conditions America's ever faced.
Thanks, Miles. I don't want to portray myself as small-minded, but I'm kind of taking the approach that we're going through a somewhat classical cycle, albeit each cycle has its own little nuances. So to take you back, and maybe to show you that the stock market is not as irrational as some people will portray it to be, in the period ended March of '09, from its peak to its trough, the market dropped about 58%. That happens to be about twice as severe as the average bear market historically. The typical bear market has been about 25% decline, so twice as severe as the average. The National Bureau of Economic Research last week finally dated the end of the recession, and they say the recession ended in June of '09, and that the decline from peak to trough in GDP was about 4.1%. So guess what? The average economic contraction of 10 or 11 previous recessions, GDP on average contracted about 2%. So we wound up with a contraction of GDP a touch over twice the average, and we had a bear market twice as severe as the average. In March of '09 at the bottom, we then saw a tremendous amount of fiscal monetary stimulus entering into the economy. My good friend Jimmy Cramer was screaming, they know nothing on CNBC, and finally, and then Geithner, by the way, to Jimmy Cramer's credit and to Geithner's credit, said he was right. We were behind the eight ball, we didn't know what was going on, we didn't fully appreciate it. We brought out all sorts of monetary and fiscal stimulus, and that has been instrumental in starting to turn the economy. I think the difference in this business cycle versus the typical business cycle is we're going to come out of this much more slowly because of the need to delever the economy, to reverse a lot of the shenanigans of the last decade that ended around 2007. But I think we will grow. I think that economic policy, whether it be monetary or fiscal policy, will be tilted towards promoting economic growth. And we live in a democracy, and they don't want instability. And so when you think about it and step back, the labor force in the United States grows about 1% per annum. Productivity grows about 2% per annum. So unless you get around 3% in real growth, the unemployment rate stays high, and growth of less than 3%, the unemployment rate will inch up. And that's socially unacceptable given that we're starting from a 9.5%, 10% level of existing unemployment. So I'm playing it like that the Federal Reserve Board, the administration, Congress will ultimately get their way. They'll figure out the right combination of things to get the economy growing in the most substantive way. And that's the way I'm playing it. And I think we should not lose sight of the fact when guys like me talk about the economy growing more slowly, and historically it's been the case, stock markets figure that out. Because today, 35% of the companies in the S&P 500 yield more than bonds. That's an unusual condition that has not existed really since 1958. 1958 was a famous year in the equity market. That was the year of the yield reversal. Prior to 1958, stocks used to regularly yield more than bonds, and really now the fact that 35% of the S&P yield more than bonds is a highly unusual condition for the last 50 years. So I'll shut up here because I'd rather hear, maybe you have the formula for me losing some weight since you're in charge of weight loss. But I think the economy slowly getting better. Stock market outlook, in my opinion, is fine. I guess one last statement. I'm like you. I have to decide what to do with money. I may have an extra zero relative to you, but the bottom line, I have the same problem to figure out. And I can keep my money in cash, which is earning zero. I don't know about you, but my bank is paying me 5 basis points, which I round off to zero, my cash. I can go out and buy a 10-year government bond yielding 2.5 or 2.6%, which I think is an accident looking for occurrence. I wouldn't want to do that. I could buy some of the higher yielding paper, so-called junk bonds yielding about 8%, they're okay. Or I could buy my favorite common stock, which yields anywhere from 0 to 4% depending upon their dividend policy, but selling at 9, 10, 11, 12 times earnings, growing at some rate, and to me, hands down, a well-selected portfolio of common stocks is the best alternative amongst financial assets at this time, given the valuation.
That's helpful. David, give us a perspective. We've talked about, shareholder demands have increased in terms of accountability. In light of a, slow growth economy, there are more activist shareholders than ever before. Nelson Peltz, Carl Icahn, Bill Ackman, the list is long and distinguished. There's obviously, you run both a public company, you run a company where marketing is really important, and you also have a significant shareholder as a private equity firm. So you're in as good a position as any to talk about level of accountability of management in general, but also accountability of return on marketing investment and tangible financial performance in terms of driving marketing accountability.
So that question would seem to require a treatise. I think in some respects, working at Weight Watchers, I frankly don't recall life not being under a situation where I had a private equity owner that wasn't a majority shareholder. So in some respects, I feel like I've been working for, and now CEO of, a company where I've always felt shareholder accountability. I've never known otherwise. I think if you look at shareholder activism, I think a lot of it was happening, frankly, prior to the issues with the economy and growth. And I think fundamentally it was a reflection of the fact that there were a lot of investors out there that they didn't believe that the CEO of the company felt any accountability truly to the shareholders above and beyond what was baked into that person's performance package. And, from my point of view, I've been at a company that has always kept the separation between chairman and CEO. So to be clear, I may be the CEO of Weight Watchers, but I have a boss. And the boss is the chairman of the board of directors. And so I've always known life where there was very direct accountability and responsibility for the performance of my business. And I've just never known anything else. I suspect what I take as normal in my job is going to become the increasing normal in a lot of other companies. I think where I feel fortunate is that, not to say that activist shareholders are necessarily clamoring for something that's going to drive shareholder value for the next 6 months, but I'm very fortunate in that I have a private equity holder that's been majority holder for now over 10 years. They want me to do the right things to drive long-term growth. That's where they see shareholder value accumulating. Any study that's worth its salt would say that it's almost impossible to save your way to long-term sustainable shareholder gains. And in fact, if you can't grow your business, you're stuck. And so I have a shareholder that's very focused on making sure that I grow my business, but they want me to do it profitably, and they want me to do it in a way that I'm going to maintain my margin structure and all that other kind of good stuff. And so in that sense, marketing has to be accountable, but at the same time, it has to drive growth.
Russ, do you want to, obviously you've gone through a similar kind of dynamic but you actually increased spend during your tenure. But you also got much greater returns on your marketing investment. What was your philosophy then, and but you also experienced we had a pretty good economy. And if you could project forward sort of in a difficult economic environment, what are marketers doing and what should they be doing when you have low growth, but you need to drive higher profitability growth than 1 to 2% or growth of GDP. So comment on what what did transpire and just sort of project forward what you think the right solution is going forward.
Sure. Well, like David, I think I feel like I've lived my whole life subject to the rigors of a private equity owner. Going back to 1987, some of you may know Tom Hicks, who has got an empire of his own now, but Hicks and Haas, which was his original partner, did an LBO with Dr. Pepper 7-Up back in 1987. And I was the CMO at that point. And I think like David, when recessionary periods come along, we're already braced for a lot of the emotional things that a manager needs to be thinking about in terms of your discipline, your rigor, your efficiencies, your productivity. And so maybe we have a little bit of a tip in on how these things go. At BK, it was, they say there's the two most important days for a private equity company are the day they buy and the day they sell. And there's a third most important day, which is the management team that they hire. And I think all three things went right for BK in that they purchased it at a great price. There was a $1 billion write-down during due diligence. So it was basically a purchase price of $2.4 billion that was written down to $1.4 billion, and that allows you to immediately have some headroom, some breathing room in terms of the financial performance that is required from you. I think you have to define activist shareholders too. You've named some individuals, but I think private equity companies are generally activists as well. And the big difference there versus maybe a normal composition of a board is that in a more normal composition of a board where you don't either have an individual who owns a big chunk of stock or you don't have private equity companies that own it, you're spending other people's money in that sort of traditional model. You're spending their money when you're in a private equity ownership or you have an activist on your board who has a giant chunk of shares. So the intensity changes in terms of performance. As I look to some of the slower growth, I'm actually very heartened to hear what Lee had to say because he knows a lot more about futures around the marketplace than I do. I personally am feeling like we're in for an economic ice age as it pertains to marketers because I think it's going to be slow growth for a long time. And I think you're going to see, yes, more requirements around return on investment, which is tricky when you're trying to run a business day to day on that basis. But I think you'll start to see some of the old tried and true strategies, people line extending off of existing trademarks, look at the mergers and acquisition activity that's growing like crazy now again. So I think you'll see people opt for things that appear to be more efficient ways to get growth, either buying it or trading on existing equity in a trademark through line extensions and those sorts of things in order to, if you will, get a better return on marketing investment.
Do you want to comment at all about that?
Well, I think the activism acceleration is really the result of the change in the character of the market. Basically, the S&P 500, which we'll use as a proxy for the level of the market, in March of 2000 peaked at 1527. 7.5 years later, October of 2007, was 1565. So in 7.5 years, it went up 2.5%. And today, the S&P is struggling to stay around 1150. So it's materially below where it was a decade ago. In that period, the hedge funds generally returned a superior return, and generally speaking, money goes where money's treated best. And so the hedge funds have grown relative to conventional money managers and we'll say mutual funds. And the hedge funds have the chutzpah or the audacity to charge 2 and 20 versus a conventional fee of 1%. So they got to find ways of generating incremental returns. And so they're not nearly as patient. They're impatient capital, and they try to go into underperforming companies and rattle their cage. So, you know, Carl Icahn would be the first to sit here and just say, corporate America, and I'm not endorsing what he's saying, but what he says, since I had dinner with him Wednesday night, you know, corporate America is incompetent, they're overpaid, they're underperforming, and we got to teach them a lesson, and we got to rattle the cage. So I think it's, we've gone from, I don't know, 2,000, 3,000 hedge funds a decade ago to 10,000 today, and they all are achieving, attempting to achieve above average returns, which means they have to make their own luck. And I think that largely explains it. You typically don't see, the exception of, say, Michael Price at Mutual Shares, when he was doing his gig, you don't see typical mutual funds, bank trust departments taking an activist approach. It's really more rest with the hedge funds.
There is one thing just to insert on that. David, is Weight Watchers is a spin-off, right, from somebody at some point.
H.J. Heinz.
Heinz.
Yep.
And so I think there's another common theme which you see, which is above market returns on spin-offs. And Lee would know a statistic around that. But my last statistic on that was somewhere between 18 and 20% superior returns versus the S&P on spin-off deals, because people were able to unlock value in a Weight Watchers brand that was maybe being smothered by H.J. Heinz or being smothered by Diageo. And so I think, you know, after this M&A period we're going to see for the next few years, it invariably will lead to more spin-offs at some point, because people are going to buy some things that didn't work out.
On the balance sheets of corporate America, we have about $1.8 trillion of excess cash. People predicted going into 2010 that you would have very modest increases in ad spending, but in fact, the results have shown to be much more buoyant than that. There's been, you know, mid to high single-digit growth in ad spending, although ad spending usually is a leading indicator of growth of GDP, but we've only had 1 to 2% growth of GDP, and it looks like ad spending will continue robustly in the second half of the year. David, tell me your point of view about why are marketers spending more money, and B, sort of how have you dealt with it at your own company, and you know, what's your philosophy going into 2011?
Well, I think that there's always, I mean, it gets back to what I was saying before. I mean, it's very difficult to drive shareholder value growth if you can't grow your business. It's just very simple math. And so I think that it is a natural instinct of management to say if we could spend more money on marketing, then hopefully that could be enough to drive growth at the top line and do so reasonably efficiently. And sometimes that works and sometimes it doesn't. You know, certainly from a marketing budgeting point of view, you know, last year advertising rates for prices were down. This year it looks like they're going to be up a bit, and so that obviously factors in as well, the supply and demand aspect of this. But you know, from my point of view, I've always taken sort of a very simple or simplistic view of how much money to spend. And I don't like operating via a budget. The budget is sort of a placeholder and it gives you sort of a sense of absolute measure, but you know, frankly, my perspective is that I am in a business that is on some level, or on many levels, it's a direct response business, in that as people engage with us and as they become members and subscribers, that's revenue in, and so therefore it's a very simple equation as to what is the cost per enrollment or cost per acquisition. And I was raised on cost per acquisition, and so my view is that the marketing mix is within a certain marginal cost, acquisition cost, you spend as much money as you possibly can. Because if you can find a way to do that, then you can grow as fast as you want. But I think if you're going to do that, you also have to be disciplined to say if something's not performing, you stop it. You know, and so I'm not a big believer in sort of advertising or marketing that, you know, builds the brand if that doesn't result in increased engagement. If nothing's happening, then it's not working, is my point of view. But on the other hand, if you're seeing increased engagement, I have an infinite appetite to spend more. And so I think that maybe that's easier for my business because it's kind of a retail business and it lends itself to that. I think it's probably a very different proposition for CPGs when sometimes they don't feel like they see as much of a direct connection between the money they spend and the sales that come in.
How do you view the cost per acquisition versus the cost of increasing the lifetime value of the customer?
You know, unlike, say, a traditional retailer where you say, if I could just get you into the door of Bloomingdale's and I could get you to become a high-spending person and I'm going to do all sorts of net present value analysis by customer segment and everything else, our business has tended to be a little bit less complicated than that. Simply getting people in the door. We know that if you enroll in Weight Watchers, that there's a very high likelihood that you're going to re-enroll in Weight Watchers. And so we factor that in, but it's not an incredibly dynamic measure. But of course, when we think of whatever it is, which is our estimate for revenue or contribution per acquisition, we then compare that against the acquisition cost, and if the economics and margins and everything else hold up and are cash flow positive, then we spend.
Russ, in 2004, one of the transformational events that you guys implemented was the utilization of viral marketing and digital marketing, and Subservient Chicken probably being one of the seminal events. You tried a lot of things differently than most of your competitors. What was it that you saw as an opportunity to redistribute your marketing dollars, and actually how did you change your sort of marketing plan from what had transpired historically going forward for that next 5 years? And what things did you try that worked, and what things would you have done differently?
Well, because it was a turnaround, there's a whole spectrum of things that are responsible for the success of Burger King. So as I answer that question and talk about marketing components, I have to pay due to a lot of the other contributors to that. Certainly one of the key decisions that I made was hiring Crispin Porter Bogusky, which made me look real smart for the following 7-8 years. And in partnership with CPB, we did an assessment around the state of the Burger King brand, and there were certain unique needs to the brand that we felt we had. And our mantra was that Burger King was a brand that people knew more than loved. And we said in response to that, we have to set about surprising people. We have to set about getting a social currency out there for the brand. And we saw collectively, our team and CPB, saw the emergence of social media, the emergence of digital media strategies through various platforms as a hyper connectivity that was taking place. And even before there were research tools out there measuring all the eyeballs that were moving, we knew that the eyeballs were moving from traditional media into some of these new spaces. And part of how we used the Burger King brand to surprise people was through things like the Subservient Chicken. What better way to introduce a new chicken that you can have your way than to have a chicken on a website that you can boss around. And God, I think it's got well over 1 billion hits, and I don't know how many tens of millions of unique users. But fundamentally, it just became the way people started to communicate and connect. And we didn't wait around for all of the metrics and research, syndicated research tools that are coming into focus now before we made that move. And we felt it gave us a leg up while some other folks were more flat-footed in our space.
When you have a low-growth economy, when you have competitors who have an economic advantage by a better balance sheet to be able to invest in your business, so what recommendations do you have where you're trying to stimulate growth beyond the growth of GDP, still keep shareholders happy by driving incremental profitability? What do you do when you have those challenges in this kind of environment?
Well, so competing against a well-heeled competitor in an environment like this is particularly difficult. Our view at BK was that smart dimes beat dumb dollars. And I think sometimes ROI, while it's very fashionable to talk about ROI, one has to be careful that it doesn't get substituted for the importance of big ideas. I mean, what good does it do to have money driving behind a mediocre idea? And conversely, if you've got superior talent on your teams and superior thought leadership, superior operating savvy, sometimes you can make those dimes work more smartly and more powerfully than the dollars of your competitor. And we felt fortunate in being able to do that. Although I have to say, McDonald's and Burger King really both together prospered and grew. We were the two fastest growers over that 7-year period. So I'm not sure it really came at their expense, and perhaps more so with some of the other players in the space.
David, a number of the people in the audience are from the advertising agency industry. And if you go to most 4A's conferences, A&A conferences, or whatever, there's always a feeling that agencies feel beaten up. That God gave the right for agencies to be able to increase their fees on an ongoing basis, but that right was taken away probably several years ago. Because the reality was there wasn't any growth. In fact, you had negative GDP growth in 2009 of 3.8%, and ad spending was down 14%. There seems to be a different paradigm. So I think all of us in the advertising agency industry are trying to deal with the new paradigm and say, how do we get growth? What can we do differently to change the relationship with our client? And how do we get paid for that? So what advice do you have for all of the minions of us that are, in the industry trying to generate growth at a time when every single piece of business changes hand at a lower fee?
You probably don't want me to say toughen up.
No, don't say anything. I want you to say whatever you want to say.
No. No, I think I think what is exciting for the agency world is what is also probably makes it a little bit terrifying, which is that it's in a period of rapid flux and change. And I think anytime you have an industry or a space that's in a time of rapid flux and change, it means that the one thing you know is at the end of it, there's going to be some winners, and it's not necessarily who you think are going to be winners, and there's going to be some losers. And so I think that it's not like you're selling sort of commodity steel where you can't quite find a way to differentiate yourself. I think there's an infinite number of ways to differentiate yourself. And so I think that it's up to everybody here to figure those things out. Now, I think, and we're always looking for creativity and new ideas and compelling ideas and all of that, and I think our view on agency fees is that, maybe one way to think about it is that what you're experiencing as a supplier is what every supplier is experiencing, which is there is not an industry on earth that I can think of, I guess maybe except Google, where, you can pretty much expect that there's always going to be pressure in your business, that you're in a deflationary environment where you have people that source a wide range of products and services, and they expect greater efficiency each year. And so I think there's an expectation that agencies are going to get better and better at what they do, that they're going to become more efficient at what they do, that they're going to become increasingly nimble, that they're going to find ways of reducing overhead in the account and everything else. But that said, I also feel very strongly that, I kind of go back to Russ's point in the first place, is that, let me be clear, if you are getting fantastic, brilliant, big idea, creative, that's driving your business, you will not find a lot of marketing teams beating up on fees. And so if there's any way to really put a nice warm blanket around yourself, it's simply to do great work. Because I sit in a lot of meetings where I hear about a lot of vendors being beaten up, but when we're really psyched about how our campaigns are going, which we are right now, this isn't coming up as sort of target number one for whatever that's worth.
I may get in trouble for saying this, but not every agency changeover results in a negotiated fee that's lower than the previous. In fact, I believe the relationship we had, we just about doubled compensation.
That's correct.
And I believe, I'm a student of David Ogilvy, who felt that pay your agencies well, handsomely, and try to become the favorite client, try to become the demand client internally so that the most talented people want to work on the business. And even with the doubling of the compensation, Burger King got its money's worth out of that because it grew over 30% over that period of time.
Yeah, I'd be misleading if I didn't sort of articulate my own point of view, which reiterates both of it. It's called the theory of compensation irrelevance. It doesn't really matter what you pay people or firms. It matters the value added that they bring. If they bring great value added, they do so on a multiple, and if they're bad, you should pay them to stay home. They'll save you money. But I think we as an industry are not used to the notion of accountability. We're used to being paid for the time or full-time equivalents that we put in, but at the end of the day, clients really should not or do not or will not care in the future. They will care about, you know, as Bill Parr says, you are what your record says you are. So if you're more nimble, more agile, and able to deliver more tangible financial performance, which ultimately has to show up in shareholder value, you know, and that's why we implemented, you know, at MDC this idea that says get every employee to own stock with every one of your clients, then you have true alignment. But if you can actually deliver that performance, I think people should be prepared, will pay you for the value you create, but paying you for the time you put in is no longer acceptable because that's not how they get rewarded. I mean, there's a whole movement, I mean, Lee, you know this better than any, that there's been a big backlash in corporate, about shareholders, about accountability of management to get paid in proportion
I don't know what
to
it's
shareholders.
accomplished yet. I mean, you know, 30 years ago, the factory floor worker made about a 30th of what the CEO made, and today the differential approaches 500 times. Corporate America is extraordinarily overcompensated. I'm a fan, like most people, of Warren Buffett. Is the problem with corporate compensation is the boards go out and they hire consultants on compensation for cover, and the consultant's name would be Ratchet, Ratchet, and Ratchet. and so, you know, I think we're moving towards more accountability. As I listen to my two panelists speak, I mean, companies just want a tangible benefit for what they're paying for. If they can't get a tangible benefit, they just want to pay for everyday service.
Last, because I want to open it up for questions, because I think that's high value added. Lee, tell us your view of today, 2011, if you had a crystal ball and you looked at sort of where we are today, 1 to 2% GDP growth, where do you think that goes? And I guess the two key drivers of a real healthy economy are housing and employment. Do you think we'll start to see, you know, more positive housing environment and more positive predisposition of companies to hire people on a permanent basis?
I think we have to get away from the Fed carrying the entire load. I think Congress has to get involved. You mentioned this $1.8 trillion on corporate balance sheets. Well, a big chunk of that is money outside the United States. And I think Congress should come up with a program led by the President to encourage corporations to bring back that money overseas, give them a tax holiday of some kind, contingent upon them hiring workers, maybe even give them the opportunity to put more of that money into their pension plans, which are becoming increasingly underfunded given the very low rates of return that are available in the marketplace. But I would go on the assumption that the economy will continue to expand at a sluggish pace, but that ultimately Congress and the administration and the Fed will come up with the formula necessary to stimulate growth, and that 3 years we'll be sitting in chairs like this wondering about inflation and how high interest rates could go. I mean, that's the kind of the history of cycles. You know, every recession sows the seeds for the next business recovery, and every business expansion sows the seeds for the next recession. So we had kind of a crazy environment where companies levered up. It was no secret. The reason all these LBOs were taking place is the private equity guys had an extraordinarily lower cost of capital than corporate America. Why? Because corporate America was running a conventional balance sheet of 30% or whatever it is, debt to capital, but the private equity guys were leveraging up 8, 9, 10 times debt to EBITDA, and they were able to get away with it because the providers of credit in the economy were very undisciplined. They weren't worrying about risk. Now that risk has returned to the forefront and they have to pay a lot more for capital, all of a sudden the strategic buyers of businesses are much more advantaged relative to the financial buyers. So it's a cycle. But I would assume, you know, God help us if we don't get the economy growing, because like I said earlier, you know, if you got the labor force growing 1%, and you got productivity growing trend line at 2%, if you don't get 3% growth, you start to get increasing unemployment, you know, a percentage point a year. And you're going to get lots of social unrest and unhappiness. You're going to get a message in November. Right now, I think the message clearly favors the Republicans. But, you know, chaos, out of chaos comes a new order, and who knows what the new order is. we have to tilt policy towards getting growth. And I would be optimistic you'll get it, less than you would have normally gotten. Let's face it, if we injected the amount of stimulus we've injected into a dead person's body, that person would be dancing now as opposed to growing at a slow rate of growth. You know, there's enormous stimulus. I've been in the business now for 43 years. I've never seen zero interest rates. You know, sitting on there getting paid zero for my savings. You know, I haven't seen a 10-year government of 260. You know, these are just numbers that you've never seen. So we're in unusual times, and hopefully we'll get the formula. I'm betting that we will get the right formula.
We have about 4.5 minutes for questions, so any questions that anyone has, ma'am. Russ, do you want to take that first, and maybe David, you'll?
The question is the idea of whether a client has multiple agencies or consolidate. Well, I think there are two ways to look at that. I think some clients actually cut their mainstream business by segments and have multiple agencies, and sometimes, for instance, a McDonald's that can make sense. The other way you can cut it is, should a client have the same holding company with Crispin Porter Bogusky and every other allied marketing service company that they may own servicing a Burger King in one consolidated sense in that way. My experience has been that the latter example generally doesn't work real well. And having been on the agency side trying to sell that, I favor individual shops that are killer shops at what they do, whether it be promotions, merchandising, PR, or broad gauge advertising like CPB. So I'm not a big fan of just turning everything over to one holding company or one integrated service.
Yeah, I couldn't agree more. I mean, right now, I feel like we have the benefit of, we've got a great agency that's doing our above the line. We have an absolutely fantastic CRM shop. We've got a digital agency that we've, Aquana or Avenue A or whatever their name is these days. They've been with us for 10 years. And they all do a fantastic job at what they do, and I wouldn't trade that in the hope of getting, so-called synergies, which sometimes are there and sometimes they're not. And so, give me best in class. If you're an agency that can give best in class truly across the board, then that's an opportunity. But, it's go for the best first.
And as a shareholder in MDC Partners, I would definitely encourage you to concentrate on MDC.
Miles, thanks. David, I think early on you mentioned about some of the innovative things that were going on at Weight Watchers. I wonder if you might take a minute or so and just comment on that.
Gosh. We have a lot going on. Weight Watchers, what we have is a brand that is very highly regarded by people that use it and know it, and they know that it works. But we have a brand where I think that, frankly, we had forgotten how to talk, at least from a marketing department perspective. I think we had sort of lost sight of where the voice of our brand really was, which is not at 11 Madison Avenue, which is where our corporate office is, but frankly, it's out in the world, in our meetings. I think that I'm very proud of the way that our team has been embracing digital for the past decade. And they didn't make it a side project, they made it a full commitment. And there's a lot of those things which is allowing us to once and for all modernize kind of who we are and what we represent, but doing it in a way that's fully compatible with everything we believe in, which is trying to have an impact on this significant health issue of obesity.
Yes, sir.
From a holding company perspective, what would be the ideal integration model for digital, traditional, and media agencies, a working model from an ROI perspective?
Well, first of all, we believe that what's most critical is what's good for the client. So when a client speaks, I think ultimately form should follow function. And what follows most effective function is when there is a lead agency who hopefully has an integrated capability. We have spent some $25 million a year for the last 5 years on building integrated expertise within each of our companies so that they are all media agnostic, that they do have the capabilities. Where they don't have that expertise resident, we really promote partnership where they work in tandem and truly in partnership, where there's a lead agency relationship, but they are the coordinator of the other disciplines of marketing. Financial success is really simple in this business. It's a byproduct of excellence. If you provide services that drive, make brands famous and drive financial performance for your client, you'll ultimately get growth and spend and ultimately greater return on investment for the holding company. Where I think the holding companies have got it backwards is they drive financial objectives first and then figure out what services they can provide and what people. We've gone the exact opposite. We say, what's the best way to provide the optimum? And I believe what David Kirchhoff said. Clients are very smart and they're very numerate. If you can show people why an incremental dollar of investment will drive a superior return on investment beyond their cost of capital, they should keep spending indefinitely. I mean, Warren Buffett is the world's smartest guy, and if you look at what he did with Geico, it's all about direct response. And basically, all he says is, as long as my cost of growth is less than my, as long as my return on growth is greater than my cost of growth, I will continue to spend. So I think I have seen this as an opportunity where I think investing in talent that really knows who understands how consumers consume influence in a digital economy, and investing in those talent and aligning their interest to drive performance for clients will ultimately drive performance for us as a shareholder. Any last question?
Yeah, I have one question.
Sure.
Do you think, Miles, and for the panel, is the industry doing a sufficient enough job to design the perfect return on marketing investment issue? We hear a lot of it. I mean, we're strangled by growth, low GDP. We're struggling to prove the return on investment. The machine is not there to prove it. We do a better job.
Well, I think the answer, I would say, everybody would say is nobody is doing a perfect job. There's no such thing as a perfect job. I think we as an industry have to accept the fact that we are in a new reality paradigm, that there is greater scrutiny. And I think instead of complaining, we should ask the question, what can we do differently to drive, better results for our clients? And ultimately, then how do we get compensated? It's a lot easier having a conversation with a client about compensation when you have positive comps that are way better than your competitors, and you have a trend line that's exceedingly positive. So I think the most important thing is continuously come up with innovative ideas by which to make brands famous and drive return, and then I think it makes the conversation of compensation a lot easier to have. I think it just reiterates what David had said. Okay, what?
One more if there is.
Okay, there's a gentleman up there.
Well, this goes back to discussing the ROI that's very important. With one of the developments that are happening in the digital space, especially not just consumer, when does the client decide on whether to hire a new talent to come on board to the company or to grow the agency? What kind of decisions and kind of thoughts do you want to make about and what you can build something internally or maybe not an agency?
Oh, and the digital side? I mean, I don't know. I mean, it's sort of, we would never do ourselves effectively digital planning, which is what Razorfish does for us. I think our view is that for digital creative, our bias is that's sort of better housed in agencies that are going to bring fresh thinking to it. But we're also maybe a little bit different as an organization because we have a 200-person software development company that does nothing but do this kind of stuff that lives internally, and we have another 100 offshore in the country of Jordan. And so when it comes to actually building and developing software, that's a line of business for us. And so that's something we don't contract out. And so we don't determine that on an ROI. We determine it more by competencies and go from there.
Rest here.
I would just say the marketplace is moving too fast around digital to try to build a cathedral inside your company. that you're going to have to tear down in a year because the challenges are different. So yeah, I think with an agency, you have more latitude. You can be more nimble as a client to either change agencies or change people in agencies, or just the very idea that agencies themselves are more plugged into change and the fluidity of the digital space. So unless you're a CRM-driven company that's built on, I don't know what an example would be, like a financial services company might want to build up a bigger capability internally than most of the rest of consumer packaged goods or services companies.
We've run out of time, so I'd like to thank Russ Klein and Lee Cooperman and David Kirchhoff for their outstanding insights, innovation, and their perspective. Terrific, and thank you very much for your time and your patience and your inquiries.